At the federal income tax level, your Social Security income is typically anywhere from 0% subject to tax all the way up to 85% subject to tax. So don't be alarmed, 85% is not the tax rate. 85% would be the amount of income that is subject to tax. So if your tax rate, let's say federal marginal tax rate was 22%, 85% of your Social Security would be taxed at a rate of 22%. So 0% to 85%, that's a really wide range. How in the world is it determined? Well, taxable income and cash flow are not necessarily synonymous. Ultimately, it's based on your other income sources, taxable income sources, and we'll go through that. But this is a good example of controllables here. So kind of like we can't control the weather, but if it's going to be sunny, I can have my sunglasses ready, or if I know it's going to snow, I can have my snowblower ready. Same way with the financial markets. Can't control the markets going up and down, but can absolutely control from which account we take income and when to possibly not have the full 85% of your Social Security income subject to federal tax. I'm Oliver Kolofsky, Director of Wealth Services and Wealth Advisor at Sweet Financial Partners located in Fairmont and Jackson, Minnesota. We specialize in working with high net worth people who are at or nearing retirement. We believe that everyone has the right to realize that their dreams are possible and use that as the focus when working with you and helping you plan for your future. So recently, I was meeting with a person who was about to retire, and they were around age 70. And they were going to need some monthly income upon retirement, which is fairly normal, very common. They would be on Social Security incomes, retirement income, but they would need more income than just what Social Security would provide. And at the time, and it's now since changed, at the time we were doing the planning, the RMD age required minimum distribution from IRA accounts. So RMD required minimum distribution. That age was 72. And now it's not 72 for anyone. But again, at the time I was meeting with the person, it was 72. So we knew what the tax situation would be at age 72 and beyond. Because we knew what the Social Security income would be, and we knew what the required minimum distribution would be. And the good news is this person had several different types of investment accounts. They had the pre-tax as it relates to the IRA. They also had Roth money, Roth IRA. It's a Roth tax-free forever if used properly. Yep. And they also had a non-IRA account. Yep. So 3 different account types from which to take income. And what we were trying to do here is optimize the tax rates so that ideally not have 85% of their income, their Social Security income subject to tax, federal income tax. So it's not always the case that we can get it to where less than 85% is subject to tax. If you have a really large IRA, I mean, just the required minimum distribution alone could cause 85% of your Social Security to be subject to tax. So what we did is we ran several tax projections. Again, we don't do taxes here, but we help do tax planning. We were running the projections and say, well, if we take money from the IRA, which is taxable, this amount of income, or this amount of Social Security is going to be subject to tax. But if we take some from the Roth, or we take some from the non-IRA account, it could cost less than 85% of the Social Security to be subject to tax. So it ended up being a really good conversation, and the person was pleasantly surprised. Actually, they thought the full 100% of the Social Security would be subject to tax at the federal level. But with planning, we were able to be intentional and really work a plan that was favorable. Again, this is something we can control. We can control from which account we take income and when. Can't control the markets, but can absolutely control distributions. So back to the original question, how much of my Social Security retirement income is taxable? So for the purposes of this, we're going to talk about federal tax only, because the states, they vary. A lot of states don't tax Social Security income. Some do. So how much of your Social Security income, retirement income is taxable? Anywhere from 0 to 85%. Is it going to depend on your other taxable income sources, including 1/2 of your Social Security income? So let's add a little clarity to that. What counts as taxable income? What would be on your tax return that would count as taxable income? Let's say you have pension income, you have rent, maybe farm rent, you have rental homes, IRA, traditional IRA distributions, dividends, wages from working, capital gains, interest income. Yep, all those items would cause more of your Social Security to be subject to tax. What doesn't count as income? Qualified Roth IRA distributions, qualified health savings account distributions, let's say basis from non-IRA accounts. If you have like a joint account or maybe a revocable trust account where you the current value is equal to the cost basis, you could take that full amount out. That would not count as income. Loan proceeds. So if you have a line of credit, get income from a line of credit, for instance, that's not going to count as income. So again, being very intentional about from which account you take income and when. So let's look at the 22 numbers, since you've probably either just had your 2022 taxes completed or will likely have those completed soon. So if you're a single filer and you have income from, let's say, 25 to 34,000, up to 50% of your Social Security will be subject to tax. If it's 34,000 and over, you're going to be up to 85% of your Social Security would be subject to tax. If you're married, so you're married filing jointly, if your income's 32 to 44,000, up to 50% of your Social Security is going to be subject to tax. And if your income's 44,000 plus, it's up to 85%. And again, these are pretty rough approximations. We have software here for you, and we can get down to the the exact percentage for you and run various what if scenarios. What if we took income from this account instead of this account? That's something we absolutely do for you. So let's think about this like in a practical application. So let's say you're in a year where you're taking Social Security income, but 85% is not subject to tax. So you haven't hit the maximum of 85% yet because you haven't had enough taxable income sources. So let's say it's year end and you're going to do some gifting to family members, let's say, and you take money out of an IRA to give money to family. All right, we covered a few moments ago that an IRA distribution, that is taxable. Okay, and again, the greater amount of your taxable income is going to cause a larger percentage of your Social Security to be subject to tax. Let's say you take $5,000 out of your IRA. Most people would think that, well, if I take $5,000 out of my IRA, my taxable income is going to be $5,000 greater on my tax return. And that's very intuitive. That's a very logical thought process. But in this case, it's not accurate. Yes, the $5,000 is going to go on your tax return, but it's going to cause more of your Social Security to be subject to tax. It's not going to be double. It's not quite double, but it could feel like a double tax because the $5,000 distribution is causing a larger percentage of your Social Security to be subject to tax. So in reality, your taxable income is going up by a decent amount more than $5,000. Now, it wouldn't be the case if prior to that distribution, we already knew that 85% of your Social Security was going to be subject to tax. It wouldn't matter, but your taxable income would just go up by the amount of the distribution. So again, intentionality, very, very key here. So to learn more about planning opportunities that are most helpful for those kind of at or near retirement, click here to watch a presentation I did live last summer called Financial Planning Opportunities for those ages 55 to 65. Got a lot of positive feedback on this one. So I go into a lot of detail regarding the nuances of planning items and most importantly, how they can help you. That's really the key part